Welcome back to the MCF Participant Education Series. My name is Hunter Nighbert, and I am a financial advisor and retirement planning specialist with MCF Advisors. In previous videos, we have talked about keeping expectations reasonable. There are plenty of documented periods where markets are up, markets are down, and flat through periods of time. With this in mind, it's important to keep perspective that cycles come and go. But it has also been documented that the overall breadth of the market provides returns over long periods of time. Our current economic climate has brought volatility in nearly all asset classes and has even moved into bear market territory at times as well. When down markets occur, it understandably increases anxiety and emotions of uncertainty for investors. The common instinct is to react as we all feel that we must do something. Often this comes from a lack of perspective from down markets in the past. While bear markets do occur occasionally, it's reassuring to know that they also have come to an end. Since 1956, there has been more than 12 bear markets followed by periods of 10 years or more. Although bear markets are inevitable, long-term investors who stayed the course through the tough times were rewarded for their patience. For example, an investment in the Dow Jones Industrial Average Index would have benefited from an average annual post-bear market gain of 7.8% 10 years after the market highs, or 12.1% 10 years after the market lows. You can gain perspective from history, but market uncertainty still makes knowing where to put your money a real challenge. When considering an investment, you might want to ask these two questions. What is a realistic long-term return for this type of investment, and how volatile can I expect that investment to be? Here's a look at long-term returns of three types of investments over nearly a 30-year time frame, from 12/31/1990 to December 31st, 2020. During this period, stocks earned an average annual return of 10.7% with dividends reinvested. Although stocks historically provided the highest returns over the years, they have also had the highest risk of losing money. Bonds had an average annual return of 8.29%. Bonds generally have been less volatile than stocks, but they too can experience swings in value. There is no example better than for this year. The rapid increase of interest rates yields have greatly impacted the price of bonds. The average annual return of cash invested in U.S. Treasury bills was 2.47. Cash equivalents historically have experienced the least amount of volatility. However, they have tended to have the smallest returns over the years and the least likelihood of beating inflation over the long term. Three sound investment strategies that can help you cope with market uncertainty are these: buy and hold, regular investing, diversification. Sticking with these strategies can be beneficial whether the market is rising, falling, or staying flat. A buy and hold strategy sounds simple, but because of our anxieties and emotions are in place, it can be very challenging, especially in down markets. A buy and hold strategy provides an opportunity for growth. As your investment grows, you are able to make money on your earnings as well as what you invested. This is known as compounding. These pie charts can illustrate powerful effects of compounding. For example, an investment of $200 a month in the S&P 500 over 5 years in this time period with no withdrawals would have totaled $12,000, and it would have grown to $18,284, 70% of that from contributions. Then the earnings would have earned their own earnings, and those earnings would have earned more earnings, and so on. After 10 years, a $24,000 total investment would have grown to $51,501, 52% of that from compounding earnings and market growth. Even with the 2000 to 2002 and 2007 to 2009 downturns, after 20 years, a $48,000 total investment still would have grown to $123,489 by the end of 2017. It's important to remember what happened in the stock market in the past may not necessarily repeat itself, and each of your investments will behave differently over time. Markets do go down, and there have been times when they have gone down significantly. However, avoiding the potential pitfalls that can come with jumping in and out of the market can help investors come out ahead over the long term. 7 of the best 10 days occurred within 2 weeks of the 10 worst days. 6 of the 7 best days occurred after the worst days. And the second worst day of 2020, March 12th, was immediately followed by the second best day of the year. The moral of the story: staying the course serves investors better over the long term than trying to time the markets. The second strategy for coping with market volatility is to regularly invest throughout markets' ups and downs. This is also known as dollar cost averaging, a gradual approach that involves investing a fixed amount in the same investments at regular intervals over an extended period of time. Regular investing encourages discipline, which is a key ingredient in any investing success, offers a systematic approach so you won't have to worry about which way the market is moving, up or down. It also keeps you investing through down markets and eases anxiety about daily market fluctuations. Now let's talk about the third strategy to help you through market uncertainty, and that's diversification. This means spreading your money amongst different investments so you don't end up with all of your eggs in one basket. Diversification has helped investors reduce volatility and in some cases can potentially increase returns. Let's see how it works. This chart illustrates a risk-return relationship of 5 diversified portfolios. Looking at bottom to top, you can see that the average annual returns increase is shown on the curve. The portfolios closest to the bottom have the lowest returns. In other words, the portfolio with 100% invested in bonds had the lowest return, 8.4%. The portfolio with 20% in stocks and 80% in bonds had a higher return, 9.09%. Risk is measured from left to right. The farther the right in the portfolio is on the chart, the more volatile it is. Who can tell me which was the least volatile portfolio? It was the one with 20% stocks and 80% in bonds. The portfolio that invested 100% in bonds was actually more volatile than this one. Diversifying the portfolio between bonds and stocks or adding 20% in stocks into the mix reduced volatility and increased return. Now let's compare that to the portfolio with 40% in stocks and 60% in bonds to the one with 100% in bonds. What did you notice? The diversified portfolio had a return of 9.65 compared to the return of 8.44 for the portfolio totally invested in bonds. Moreover, the volatility of the 40% stocks portfolio was slightly lower than the 100% bonds. This is another example of how diversification increased return while lowering volatility. Now let's look at the right side of the chart. What was the return of the portfolio with 100% invested in stocks? It's 10.7. And what was the return of the portfolio with 80% in stocks and 20% in bonds? It was 10.45. Though there was not a considerable difference in return, the portfolio with 100% in stocks was much more volatile. While conservative investors with portfolios on the far left of the chart can use diversification to potentially increase their returns, aggressive investors with their portfolios on the far right can use it to potentially reduce volatility. Rebalancing is simply readjusting your portfolio back to the original asset allocation that took into account your risk tolerance and time horizon. Rebalancing ensures that you adhere to your investment strategy. You rebalance by selling assets that make up too much of your portfolio and use proceeds to buy back those that now make up too little of your portfolio. Ultimately, regular rebalancing can increase the overall return of your portfolio over time. An automatic rebalancing feature may be available through your current retirement plan provider, and visit your provider's website for more information. It has been said that the two main emotions that drive the markets are fear and greed. Sharp volatility and down markets are hard. They create anxiety and emotions that can cloud our decision making. When the markets are down sharply, we tend to get consumed by it more than when the markets are going up, up, up. When investing in an uncertain market, here are some simple rules to remember. Set realistic expectations. You may not be able to predict the market, but you can learn from history. In addition, recognize that market declines are natural and eventually end based on historical data. Stick to sound investment strategies. We discussed 3 specific techniques: buy and hold, regular investing, and diversification, and the various potential benefits that they can provide if practiced consistently. These strategies can help you effectively cope with the market uncertainty and keep you focused on your long-term financial goals. During periods of market uncertainty, it is critical that you stay committed to your long-term objectives. Be patient and ride out the waves. Bull and bear markets come and go. Look for other opportunities that you can take advantage of in down markets for your overall portfolio as well, such as Roth IRA conversions and tax loss harvesting for taxable accounts. Reach out to me with questions if you feel like you are unsure about a decision regarding your retirement. Until next time, hang in there and have a great day.